मरघट तक है तेरी कहानी पग पग प्यारे दंगल 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 सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे दंगल 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 दंगल.
Great morning, my dear friends. Bhupesh Anand this side. So today we'll be starting with, a new chapter named as lecture number 2, and I will be discussing with learning outcome number B, corporate finance, capital budgeting, lecture 2, learning outcome B. So I will be doing with learning outcome B, and that is the most important learning outcome, because it will build your base. So in today's lecture I will be discussing with learning outcome B, that is what are the basic principles which are to be taken into account in a capital budgeting project. So I will be focusing on the basic principles of capital budgeting project, that what are those principles to be taken into account. So I will be telling you what is project sequencing and what is capital rationing. These are the three projects I will be dealing with. So please take out your registers. Today lecture will be very, very important. I have prepared some handwritten slides for you. You have to write down very small, very 2 or 3 slides are there. But the point is, before writing those slides, you should firstly listen to my lecture. You should listen to me and see the body language, the examples which I am giving you to understand the concepts. So let me start. There are 4 basic principles as per learning outcome B, a highly testable area. Basic principles. There are 4 basic principles. Four basic principles of capital budgeting decisions, which a CFA, which a charter holder or an aspirant CFA or a finance manager should take into account before accepting or rejecting any project. The first, and it will be, we will learn it with the help of CFTO. So first principle is, principle number 1 is, when I say C, I mean cash flow. The first principle is named as cash flow. In capital budgeting decisions, we will not consider the profit. We will not decide on the basis of profits. A project can be profitable, but actually is not actually yielding us any cash flow. So my decision should be based on cash flows. When I say cash inflows, it means rokda kitna aata, rokda kitna jata. I will be deciding on the basis of these hare green notes, not on the basis of profits. When I say cash flow, I mean cash outflow and cash inflow. Because how much cash will be going out from this project if I accept this project, and how much cash will be coming in my business due to this project. These are the 2 basic criteria on the basis of which we should take any decision. The point is the profit which we calculate from the profit and loss account, from the profit and loss statement, from statement of income statement, that can be manipulated because it depends upon so many accounting estimates. It depends upon so many judgments that we have already discussed in financial reporting analysis. That with the help of different estimates or different judgment, different methods. Even in case of depreciation, we have discussed in FRA that depreciation can be charged either on the basis of double or declining or straight line or number of years of digits. There are different methods. Even in stock, in inventory, we have different methods, FIFO, LIFO and all that. We have already discussed in FRA. So the point is, profit can be manipulated. Profit can be increase or decrease because it is dependent upon the accounting policies. So capital budgeting team may reject those projects which are showing profits, but still capital budgeting team will not accept them, will reject them, because all that glitters is not gold. All that is glittering is not gold. So the first principle which we have to keep into account is cash flow. Cash flow. When I say cash flow, I mean cash going out and cash coming in. That something is named as cash flow principle. So CFTO. I have written CFTO. When I say F, I mean principle number 2, and it means financing cost. Let me explain you very important concept. It means financing cost. We should ignore financing cost while accepting or rejecting, or while evaluating a capital budgeting project. We should ignore financing cost. We should ignore financing cost. Now, what is the meaning of financing cost? It means the project which we have undertaken, the project which we have started, how it has been financed, whether it is financed with the help of debt, or whether it has been financed by bank loan, or whether it has been financed by equity, because that is named as financing a project. Now we have to pay something in return to those persons who are the providers of funds. I repeat, we have to pay something to those persons who are providing us the fund. For example, in case of debenture holders, we are giving interest, that is cost of debt. Now the point is, in capital budgeting decisions, whether these funds are arranged through debt, whether these funds are arranged through equity, or whether these funds are arranged through reserves and surplus, we will not consider the cost of either of these. That is, I will not consider cost of equity, not consider cost of retained earning, I will not consider cost of debt. So in a capital budgeting decision, my emphasis will be to put the greater emphasis, the highest emphasis on ignoring financing costs. Now, for example, let me give you one example. In capital budgeting decisions, we will be preparing one timeline, that is, supposedly this is a timeline T0 and T1. When I say T0, it is the beginning of the period, or it is in the beginning of the year. When I say T1, it means it is at the end of the 1 year. Supposedly, I am getting a cash inflow of $100 in year 1. No. Let the rate be. Let the discounting rate. Let the time value of money rate be 10%. Let the discounting rate be 10%. I have already told you what is the meaning of discounting rate, what is the meaning of inflation rate, what is cost of capital. I have already told you. Supposedly the rate is 10%. Now, in capital budgeting decisions, because we have to take decision at T0. So mind it, I will bring that future cash inflow, into a zero period. I will bring that future cash inflow at zero period, at present tense. And what I will be doing? I will be doing using the concept of time value of money. For example, $1 today, $1 today will increase to $1.10 after 1 year. If after 1 year $1.10 is there, then $100 will be equal to how many dollars at year 0. So I will be doing 100 into 1 upon 1.10. That comes to $90.90. My dear friends, at the time of calculating the present value of future cash inflows, I have considered the discounting rate. And directly or indirectly, I have already taken the effect of cost of financing. So if I consider interest cost in the beginning also and at the end also while calculating present value, it will tend to amount to do double effect. So please listen to my loud voice and please write down in your registers that we will only consider cash flows and we will not consider financing cost. Financing cost is already taken into account while calculating discounting rates. My mnemonic is CFTO, 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 CFTO. Now I am coming to T, that is tax. We will consider tax. We will consider the impact of tax. We will consider the impact of tax in capital budgeting decisions. And it is only after that I will see how much is the relevant cash flow. I repeat, there can be a total cash inflow of $100 and the tax rate is 30%. Let us assume tax rate is 30%. So what I will be getting in my home, relevant cash inflow will be $70. It means I will take into account the tax effect because I'm not getting 100 rupees. I have to pay 30 rupees to the finance ministry and I will be getting only $70. So whether I should consider $70 in my capital budgeting decision or $100, the point is, the principle is, I should consider after tax cash inflows, I should consider $70 and I should not consider $100. So this is my principle number 3, that always take into account after tax cash flows. And those after tax cash flows are named as relevant cash flows. So I have discussed 3 principles. So I am coming to principle number 4, CFTO. Fourth principle is consider opportunity cost. Consider opportunity cost. Consider opportunity cost. Consider opportunity cost. It means I should consider opportunity cost into account, which is named as imputed rent, imputed interest. So let me give you an example. Supposingly this is a building, this is the owner's building. Mr. A is a owner and he is using this building for his own business purpose. He is using this building for his own business purpose. And the alternative option available to Mr. A is that he can give on rent. If this building is given on rent, then he could have earned $10,000. Then he could have earned $10,000 per annum. Mr. A, I'm talking of Mr. A. I'm taking the example of Mr. A to explain you what is the meaning of opportunity interest. What is the meaning of imputed rent? I'm supposingly Mr. A has his own building and that building he can either give on rent or he can either use it for his own business purpose. And if it would have been given on rent, then in that case he would have earned $10,000 on that building by giving on letter of purpose. Now the point is this building is being used. This building is being used by Mr. X for his own business, and from his own business he is getting a sales of $25,000 per annum. I'm using the numbers so that you can understand better. Sales is $25,000. Supposedly the sales is $25,000, and the rent which he could have earned is $10,000. So the point is, when I want to evaluate a capital budgeting decision, that whether this capital budgeting project should be accepted or not to be accepted. Now in that case, whether I should consider sales as 25,000 or I should consider sales as 15,000. So as per the basic principle which we will be using in capital budgeting, as per LOSB, we will not be using the sales of $25,000. we will be rather firstly deducting the opportunity cost, because in any way I would have earned $10,000. So the net benefit from that project is not $25,000, rather it is $15,000. So this is named as opportunity interest. So like this, we will consider the concept of opportunity interest. Let me give you another example of Coke. Let me give you another example of Coke. Now there are two versions of Coke. One is normal Coke, that is with sugar, and other is diet Coke. Supposedly, Coke with a normal Coke, that is before coming with diet Coke, that is supposedly only we are selling normal Coke. It means Coke has company is only manufacturing a normal Coke, and $500 million, let the case be, is the sales. Now they have again started, they want to start a new product named as Diet Coke. Now when they are evaluating that Diet Coke, that whether Diet Coke should be manufactured or not, whether this new expansion should be there or not, whether there should be product expansion or not. Now whether supposedly they have evaluated that sales will be $400 million, and they have already also checked that when they will start with Diet Pepsi or Diet Coke, their existing sales will reduce, because some of the customers they will shift from normal Coke to Diet Coke. I am assuming let $100 million be the reduction in sales in normal Coke sale, because those customers will be shifted to Diet Coke customers. Now the point is, while evaluating Diet Coke, whether you will see, whether you will consider the sales of $400 million, or you should consider the sale of $300 million. Now one student is wondering that from where we got $300. Now this concept is also named as cannibalization. You have heard of cannibalization? When I say cannibalization, it means shifting of existing customers to a new product, because the company has launched a new product. For example, iPod. Apple Computers is coming with a new iPod series, mobile phones, 6 series, 7 series, 8 series. Now, the day they announce that they are coming with 9 series, the customers who are ready to purchase 8, they will wait, and they will shift their preference from 8 to 9 series. It means this concept is named as cannibalization. It means existing sales has been reduced. Existing sales has been reduced, and those customers have been shifted to new one. So this is cannibalization, or I will say this is opportunity sale. So I will not consider $400 million as sale of Diet Coke while evaluating the project of Diet Coke. Rather, I will deduct this 100 million sale, because this is existing sale which has been shifted from this to this. So the net result will be $300 million sale. So I will be considering $300 million sale. So this concept is named as cannibalization. The logic is we have to use 4 principles. The first principle is cash flow. The second principle is financing cost. The third principle is tax. And the fourth principle is opportunity cost. We will consider cash flow. We will consider tax. We will not consider financial cost. And we will consider opportunity cost. And now I am coming to new concept. I will be telling you 3 terms in today's learning outcome, or in today's lecture. The last phases we will be discussing with 3 new terms. First term is named as meaning of mutually exclusive projects. So please sit down properly. You have to sit straight. आपको सीधा बैठना है, आप झुक के नहीं बैठेंगे. आप जब झुक के बैठते हैं तो आपको नींद आती है. It means you will feel slippery if you sit down like this. You have to sit like this. And please take out your registers. Firstly, we should write down something. When we write down and when we listen, that concepts will be more better crystallized clear. So let me complete this slide. We will be discussing with 3 terms more in this lecture number 2. term 1, term 2 and term 3. Term 1 is mutually exclusive projects. Term 2 is project sequencing. I will be telling you what is the meaning of project sequencing, and the term 3rd which we will be discussing in this is capital rationing. What is capital rationing? What are the types of capital rationing? What is a capital budget? How we will select it? What are the combinations? But before that, please take out your registers and please write down something, Only 2 or 3 slides are there. Lecture 2, capital budgeting decisions. Learning outcome B. Learning outcome B. First point, please write down. Capital budgeting decisions are based on, this is principle number 1, CFTO, or I can also write on CTFO. Capital budgeting, it is principle number 1. ये principle पहला है जो आप लिख रहे हैं. आप ढीले ढीले मत लिखिए, आप प्लीज लिखिए, रजिस्टर्स में लिखिए. I have prepared this handwritten slide specially for you. मैंने सब कुछ आपके लिए बनाया, इतनी मेहनत की है. प्लीज लिखिए. कैपिटल बजटिंग डिसीजंस आर बेस्ड ऑन कैश फ्लोस एंड नॉट प्रॉफिट्स. ये सबसे इंपॉर्टेंट बात है कि जो पूरी कैपिटल बजटिंग का जो लॉजिक है, द फाउंडेशन इज कैश फ्लोस एंड द फाउंडेशन इज नॉट प्रॉफिट्स. No doubt a profitable project can have a negative cash flow. So we will not accept it. So we should consider cash flow. So first point is capital budgeting decisions are based on cash flows and not profits. First point. Because I have given the reason in second point. Because profits can be manipulated, profits can be decreased, profits can be increased because we are using some accounting concepts as per FRA. So read like point number 2. In capital budgeting decisions, we have to consider, I am underlining, we have to consider the effect of tax. दोस्तों, every country charges some tax, corporate tax on the corporates, personal tax on the personal income. It means there is a difference between personal income and personal disposable income. Again, there is a difference between total corporate income and the income which is actually being received to the stakeholders, because we have to pay something as tax also. पुराने जमाने से राजा महाराजा कर लेते आए हैं. कर, लगान मूवी आपने देखी होगी, लगान लगता था, और लगान के बाद ही द अमाउंट which you have to pay as a लगान to the government, after deducting that, the net figure, the net balance is named as cash flows after tax. Those are to be considered. So in capital budgeting decisions, we have to consider the effect of tax. That is, decisions will be on the basis of after tax cash flows. After tax cash flows. Point number 4. In capital budgeting decisions, we have to ignore financing costs. We will not consider financing costs. I have already told you that it will give to double tantamount tax, double effect. So we will not consider the cost. So please write down principle number 4. Fifth point, in capital budgeting decisions, we will consider opportunity cost. So I have given the example of a house. Mr. X house, rent and all that. So please write down opportunity rent of own building using business premises. And then I have given the example of cannibalization, that is relevant cash flows to be considered. When I say relevant cash flows, it means I will deduct opportunity rent, I will deduct opportunity interest, and the balancing figure will be named as cannibalized relevant cash flows, and this effect is named as cannibalization effect. I have given you example of Diet Coke, Diet Pepsi with normal Pepsi. So the next point is launching of new iPhone series. So the reduction in the sales of old version because the customers, the prospective customers, they have shifted from old version to new version. That is named as cannibalization. So how much is the sales we will consider for new version? Again, that is there. Now I am coming to the three terms named as mutually exclusive projects, project sequencing, and capital rationing. Now, what is the meaning of mutually exclusive project? When I say mutually exclusive project, if I toss a coin, then either head will be there or tail will be there. Head and tail both cannot be there. Even in a dice, either I will get 1, 2, 3, 4, 5 or 6. I cannot get two numbers. I will say head and tail are mutually exclusive. It means acceptance of one project automatically means rejection of another. I cannot accept both the projects. मैं दोनों projects को accept नहीं कर सकता हूँ. Either I will be pass in CFL level 1 or I will be failing in CFL level 1. If I say I am pass in CFL level 1, it means I am not fail in CFL level 1. It means these projects are mutually exclusive projects. I cannot accept both the projects, even in capital budgeting decisions. There can be so many types of projects before Mukesh Ambani, and out of some projects, there can be mutually exclusive, and all are profitable. So we have to find out which project should be taken into account. For example, I have just given the example of pharmacy shops in USA. You can search from Google in the year 2010 or 11. This happens in USA that pharmacy, medical shops, they were selling medical medicines as well as cigarettes. But after some movement came there, and now they have a choice that either they can sell the medicines or they can sell tobacco or cigarettes, because both are anti these, I will say, mutually exclusive projects. No doubt you can sell. I am just giving the example of case study of medical shops in USA. So I will say either you can sell this or you can sell this. So it means these projects are mutually exclusive projects. Now supposedly there are 4 projects and all 4 projects are profitable, but I have to find out which project is to be accepted. It means if I can accept A, then I will not accept B, C and D. And if I accept B, then I cannot accept A, C and D. And if I accept C, I cannot accept A, B and D. So these are mutually exclusive projects. Hope you have written that. So I am coming to next slide. Next concept, next term, that is named as project sequencing. For example, before going for level 3, CFL level 3, you have to clear level 2. And before attempting or before sitting for level 2, you have to clear level 1. It means it is in a particular sequence. Level 1, then level 2, and then level 3. It means you have to follow a particular sequence. Supposedly level 3, I'm just assuming, I'm just taking an example. Level 3 is very difficult. Level 2 is level 3 is very easy. Level 2 is difficult, and level 1 is very, very difficult. But to reach that CFL level 3, easy level, you have to cross this difficult level 1, and then you have to cross this difficult level 2, and then you have to switch to difficult simple level 3. Oh, I'm just explaining it. Let it be like this. There are 3 projects. Project A, Project B, Project C. Project B is loss-making project. Project B is loss-making project. But Project C is a profitable making project. So the point is, I want to accept Project C because that project is profitable. But I cannot accept standalone Project C. Now, before accepting Project C, it is important that I should have selected project number B. Now in project number B there is a loss, but I have to select it because I don't have any choice, because for C I have to do this B, and again for accepting project B I have to accept project A. Again in project A there is a loss making project. Again I have to accept it because my focus is in project number C. So this is named as project sequencing, which is the first project I should accept, even though it is loss making. which is the second project I should accept, and which is the third project I should accept. So please write down project sequencing. Project C is a large profitable project, but in order to reach at project C, you have to accept project B. And for doing project B, you have to accept project A. No doubt project A and project B both are loss-making projects, but still you have to accept it. And firstly, you have to accept project A, then B, and then C in this priority, in this preference. This is named as project sequencing. So the last term of today's lecture will be capital rationing. Please prepare this diagram, this example also, this flow chart also, because flow chart will explain you each and every concept. So I am coming to last term, and that is named as capital rationing. For example, in June or December examination, you want to do all the 4 subjects through curriculum, through Squazer, through my notes and all that, but you have limited time. Time is short supply. It means from that limited time, you can do only few of the subjects out of those 10 subjects. So you will select those subjects which have huge marks weightage. For example, ethics, financial reporting, quant, economics, they have the huge marks weightage. This will be considered as A category subjects. And the second category is corporate finance, portfolio management, equity, and fixed income. When I say second category, it means I'm bifurcating from the point of view of marks. So let it be second category, and the third category will be derivatives and alternative investment. So you will be doing the project which has highest marks weightage. It means I cannot do all the things. I have a limited capital budget. Mukesh Ambani has a limited budget. So I cannot accept all the projects. No doubt all the projects are profitable. So I have to select the best combination from that. And that best combination from those projects is that process is named as capital rationing projects. Within that, we will be having 2 types of projects: divisible projects or indivisible projects. For example, I want to purchase a helicopter, and helicopter costs $700 million, but I have only $400 million. So I cannot buy a helicopter because I have limited funds. So either I can buy the fan of helicopter or tires or motor. No, because helicopter is a indivisible project. Supposingly I want to construct a building. मुझे बिल्डिंग बनानी है, बिल्डिंग में मेरे पास पैसे लिमिटेड हैं, so I can manufacture, I can firstly construct ground floor and first floor because I have limited funds. Then after some period, after some year, I can also build second floor. So this is named as divisible project. So there are 2 types of projects that we will discuss. Firstly, write down what is capital rationing in case funds are limited in nature. Capital budget is limited, but there are a bundle of profitable projects. So the optimum combination will be which have the best, the maximum NPV. That will be considered as the optimum combination of the projects, which will be selected. For example, I have just given an example that my budget is $700 million. So I have 5 projects. All are positive NPVs, but they have different outflows. Let's now see the total of outflow. The total of outflow, this is more than 700. It means I cannot accept all. It means I have to prepare the combinations. Either AB or AC or AD or BC or BDA, as a case may be, depending upon the total funds available and the outflow involved in a particular project. So this process is named as capital rationing process. Hope you have enjoyed the lecture. Be happy, be jolly, be cheerful, be happy, be jolly,